Hey there, everyone. Today on the Final Bar, a rare down day for stocks as the Nasdaq pulls back after recent gains. Over 70% of the S&P 500 stocks are above their 50-day moving average. Is that a good or a bad thing going forward? Marianne Bartels of Sanctuary Wealth will be joining us from the New York area. What are the charts that stand out for her between now, year-end, and beyond? Ladies and gentlemen, this is the Final Bar. Hey everyone, welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we break down the market action based on the premises of technical analysis. The technical toolkit really designed to empower investors to improve their situational awareness, improve their awareness of what's happening around them. I find so often novice investors sort of put the blinders on. You look at a particular trade, a particular stock, a particular chart, kind of ignore the forest for the trees, right? You're so focused on the bark on one particular tree, you forget to take a step back and really understand the overall environment that you're in. That's where technical analysis can be super valuable. It's very easy to look across sectors, across groups, across themes, across market cap styles, across global regions, across all sorts of different risk assets and compare them on an apples-to-apples basis using the premises of trend following, technical analysis, and so much more. We'll do our best on this episode, as always, to help you make sense of what happened in the trading day today. A bit of a give-back day after the recent gains in the S&P and the Nasdaq, but overall still holding up quite well. Let's get to our market recap and look at how the charts played out through the course of the day. Before we look at the charts, I do want to let you know about a poll we had recently on our social media, so make sure you follow us on the socials, and also don't forget to subscribe to our YouTube channel. You won't miss the next poll. We asked you, which of the FANG stocks would you most like to own for the next 2 months? We're here in mid-November. That would take you basically through the new year to mid-January. Meta, Apple, Amazon, Netflix, Alphabet. The most responses we got pretty much tied between two, Amazon and Alphabet, which is actually kind of interesting to me. I thought in Apple, kind of the technology leadership would get a little more of a nod. 19% is not bad, but I figured it'd be a little bit better. Given the dominance of technology, it seems like recently with Microsoft obviously wasn't in the original sort of group of five FANG stocks. Maybe if that would have been, it could have gotten a bit of a nod. Let's look at the charts of the two that got the most votes. Amazon number one, Alphabet number two. And what's so interesting about both of these, by the way, I think at this point, I wouldn't have a problem with either one of those. And I think owning any of these mega cap growth names, maybe with Netflix excluded because it's kind of an outlier from a technical perspective, but the rest of these kind of holding up pretty well. Many of them, if not all of them, kind of testing the upper end of this range. And when I think about the markets between here and the end of the year, which is only 6 weeks away or so, when you think about that sort of period, I think a lot of these names, Nvidia, of course, reporting earnings today, testing significant resistance. The S&P 500 getting closer to 4,600, which is the high from the summer resistance as well. Same with Amazon, right? Kind of testing key resistance. So I think from a technical perspective, the real question from here, now that they've had the run that they have in November, they're kind of stalling out a little bit here in the last couple days. Do they move above that resistance level? Does an Amazon get above 145 and hold it? And of course, the bull thesis, I would argue, for stocks in general, probably involves growth stocks doing better than they have already, right? Kind of continuing this uptrend, which means we can't just trade to that resistance level; we have to trade through it. So I think that's an important thing to look for. Probably out of all of these, I would probably vote Meta from a technical perspective, only because it's the one that's actually broken out already. It actually has made it above those previous highs, while others have not. But I get the argument for any of them. I think you can make a case for growth given the environment that we're in. We have a great guest today, by the way, Marianne Bartels, who's been on the show before, talking a little bit about the environment, the outlook for growth stocks. So we'll leave further discussion for my comments with Marianne. Let's get to the rest of the market recap. As I mentioned, a bit of a give back day. And again, we've only had, I think, 3 or 4 down days in the month of November. This might be the third one. So it hasn't been that often that we've had any red on this front page. But here we are, the NASDAQ composite down just below 14,200. That's down 0.6% from yesterday's close. The S&P 500 finishing around 45.38, and that's just down 0.2%. So really not that big of a down day. I don't think you could lead with the headline, major averages plunge to the downside. It's not that kind of day. It's just sort of a normal give back day. Now, small caps might be noteworthy. They're down about 1.2%. So the worst performer out of this group of major U.S. and North American benchmarks. The VIX actually moving down, so this is a good friendly reminder, PSA, that while we think of the S&P and the VIX as inversely related, which generally speaking they are, that's not a one-to-one comparison. Right? It's not 100% true. So there are days like today where the S&P and the NASDAQ move down and the volatility actually comes in. There are times when the market moves higher on higher volatility. Because you have to remember, this is looking at the volatility in the S&P index options market, which means not directly related to what we're seeing with the underlying indexes themselves. So the VIX continues to pull back. Again, not too much. I mean, it's down just slightly from yesterday, but still in that 13 handle. And that's putting us in the range of the low volatility environment that we experienced really in the bulk, sort of the meat of the bullish phase in earlier in 2023, kind of had a VIX around these levels. We had a bit of a warning sign recently when the VIX had pushed above 20, and that was sort of one of the back of the envelope, this is a high volatility environment. Usually more happens in a market downturn. It didn't stick. The VIX remained above 20 just for a short while and then came right back below. Now right back to those low volatility periods. So as long as the VIX remains around these levels, it's hard to interpret that as anything but bullish at this particular time, I would argue. Interest rates really kind of an unchanged environment right now. The 5-year, 10-year, and 30-year pretty much where they were yesterday, so not a lot of movement. The bond markets, the TLT, essentially flat, no change from yesterday's close. The dollar just slightly higher. So overall interest rate environment, one of those days where there wasn't a ton of movement to be had. It was kind of a choppy day, but at the end, finishing pretty close to where we started the trading day. The commodity space, for the most part, in the green. You can see crude oil prices slightly higher, gold and silver prices higher. We'll talk a little bit about gold charts if we have time during the market recap. The silver ETF, SLV, was up about 1.4%. The GLD, the gold ETF, was up just over 1%. It's kind of interesting space to watch because gold has been testing resistance for quite some time now. The GLD, the GDX, which is the gold miner ETF, kind of bumping up a key resistance level. I think the GDX is around 30. Might be worth watching to see if we do get a breakthrough going through this shortened holiday weekend. Cryptocurrencies, a lot of red, kind of a choppy environment as always, but Bitcoin currently just below 37,000. Ether has dipped now below 2,000. It's around 1994. You can see down slightly, about 1.5% from yesterday. Just to finish off, looking at the 11 S&P sectors, kind of mixed, more down than up. But at the top of the list, we have healthcare, the XLV up 0.6%, materials and consumer staples rounding out the top three. On the bottom, you have technology down to 0.8% lower, real estate down 0.5%, communication services down about 0.33%. It's not a huge volatile day in terms of sectors as once all was said and done here at the close. Let's go to a daily chart of the S&P 500 and see what happened today versus the overall trend. So, of course, yesterday we had the big up move. I mean, just a nice big follow-through day. What's interesting when you look at the chart of the S&P 500, I'm just going to zoom in to maybe the last 6 months or so. What's interesting about the chart of the S&P is, coming off of this low at the end of October, I mean, just really an aggressive move higher in the month of November. And if you follow seasonality, as I feel like I've mentioned many, many times, not a surprise at all, right? I mean, if you look, looking ahead through the course of 2023 at the beginning of the year, what are my biggest up months? Probably like June, November, probably the two best months. December might be third from that, would be my guess. And so far, that's kind of how things are played out. June was pretty much strong as it often has been. November, incredibly strong as it usually has been. You often have a major low, September, October. You often have a nice recovery in the fourth quarter. This year is pretty boring in terms of not diverting too much from that normal seasonal playbook. Good reminder to, when you're looking forward, thinking about the year to come, think about the seasonality because some years like this, it just plays out miraculously well. And you just want to be aware of it, be on the right side of it if you can. But the follow through has been impressive. Here's that gap from last Tuesday. That's when we had the latest CPI reading. You saw the gap higher and then the follow through. This was yesterday's session, another push to the upside. Today, a bit more of a doji candle on the S&P, kind of a open and close pretty close to each other. So really not following through, kind of stalling out from yesterday's close. But again, undeniably in an uptrend of higher highs and higher lows. We're watching this overbought condition. Overbought on its own is not a bad thing. It's actually, I would argue, a pretty good thing. When the market becomes overbought, that means it's gone up a lot. That's kind of what we want. But you want to think in the short term, the tactical time frame, how long a market can sustain this sort of pace. And that's what the overbought conditions often indicate, that you may be ripe for a bit of a pullback here. I don't know if I would expect that in a shortened holiday week, kind of the normal playbook over like a Thanksgiving holiday is kind of flat to positive, lower volume. And then next week is when things really start to get interesting. And that's when you have that gap between Christmas and New Year's. That's when you have sort of Cyber Monday and a big influx of revenues for retailers, and see how things sort of play out. But expectations, of course, are usually pretty elevated. The 4,600 level, not too far above current levels, less than 100 points away. And that's, I think, that green shaded area, a key one to watch through the end of the year to see if we're able to get above that potential area of resistance. I want to look at just a couple breadth indicators here, and then we'll look at some individual names to complete our discussion about the market recap. Here we're looking at the advanced decline lines. I haven't updated these colors on this particular chart yet, and I think what I would probably do at this point is I'm going to switch them very quickly to, let's see, orange at the top. We're going to make the next one green because that's the S&Ps, and then we're going to keep the other two sort of in a neutral orange. This is you are witnessing the very subjective Dave Keller color coding system, just looking at the chart and looking at what levels I think are important, what trends. And when we're looking at the advanced decline data, this is the cumulative advanced decline line for the four major groups that we track it on. The New York Stock Exchange is a pretty broad use, a list of U.S. stocks. We have large caps, the S&P 500. We have the S&P 400 mid cap breadth, and then the S&P 600 small cap breadth. Now, all four of these actually are now above the 50-day moving average as of today's close. The small cap just got above there, which is why I'm putting it back to neutral orange. The S&P is the only one that's gotten above its October high and basically has eclipsed the previous month's high. The rest of these still kind of waiting, but look at the improvement you had from the end of October when all four of these are making a new swing low to where we're at now, where all four of them are above their 50-day moving average, and at least one of them, the large cap breadth, is breaking above the October high. And what's interesting is the market itself has already broken well above its October high. We're even talking about the 2023 high in play, and whether or not we'll be able to get above there. The breadth data has lagged behind, and I think that has to do with the leadership, as we'll talk about a little more later in today's episode. But overall, these breadth indicators continue to improve. Getting above the October high, so I can color code them all green, I think that would validate a pretty good bullish thesis through year end. Now, another breadth indicator to look at, I kind of hinted at this in our introduction, is this bottom series. Here's the S&P 500. Below that, we have the percent of S&P stocks above their 200-day moving average. The fact that this is above 50% is one of those basic breadth assessments that I like to make. Above 50% is bullish, below 50% is bearish. And the fact that we're back above there just says that this is a bit of an all clear, telling you that the strength, the broad advance is enough to validate this recent uptrend. I want to focus on this particular indicator at the bottom. This is the percent of stocks above their 50-day moving average. And I don't have a hard and fast rule on this because the range in this indicator actually fluctuates quite a bit. If you look back in 2021, 2022, you rarely got up to 90% or down to 10%. It's just become much more exaggerated here in the last 18 months or so. But I can't help but notice, looking to the left on the chart, some of these previous times we've gotten up above 80%, up toward that 90% level. The last three times that has happened, which is really the last three times in the last couple of years, the July market peak, the November 22 market peak, and the August 22 market peak. And so when you get up to those extreme bullish breadth indicators, particularly on the short-term measure of breadth, the stocks above their 50 days, currently around 72%. We get above 80%, I would say that's one of those indicators that might suggest we're sort of near the end of that uptrend. So when you have a market in an uptrend, which I think we are, two things. Number one, follow the trend and look for reversals, trend reversals, but also look for some leading indicators. And I think this might be one. If you look back, there have been some great signals that have suggested that the uptrend may be over. I don't think we're there yet based on that indicator, but pretty close to where you might think of initiating that as an exhaustion signal. Something to think about. Now, we mentioned some individual names, and we'll finish after just talking about those. Nvidia is now testing resistance 490 to 500. 500 is where we peaked out here in August. We're kind of right back up to that point. Nvidia reporting after the close today, down about 1%, so just slightly during the course of the trading day. Now, they reported after the close today. You can see just up about 1/3% more in the after-hour session. It is trading just slightly above 500. I don't put a lot of weight into the after-hours trading until you sort of get through the earnings call and get all of that new information kind of priced in here. So certainly something to watch going into tomorrow's trading. But for now, Nvidia, I would say the question is, from a technical perspective, getting above that August high and holding it, which means Nvidia above 500 is a pretty constructive chart kind of languishing and trading below there. All of a sudden, this is a stock facing resistance and unable to break above it. So I think that's a big question for the market moving forward here. Alphabet, of course, is one of those charts to think about when I'm asked about the mega cap names and just thinking about some of the growth stocks. Names like Nvidia testing resistance, names actually able to get above those levels. Something like a Microsoft already breaking above its summer high, I think is pretty encouraging. The chart of Alphabet, I mean, I get the argument that it's a bullish chart. I would probably say not as much, because until you get above this October high, the last thing I saw was undercutting the September low and the August low in a pretty big way. This thing gapped down and went further. Now, it's obviously there have been buyers coming in pushing it higher, but this isn't really a bullish configuration just yet, I would say. And the reason why I would say it's not is you're not making a higher high. The momentum is still relatively weak. The RSI is still below 60. So close, but not quite there. And so I think you want to be careful about names that you think are bullish or bearish just because of the environment, as opposed to what would you need to see on this chart, right? What's that checklist look like where you would confirm this is now breaking out? I think a chart like Alphabet actually still has a little bit to prove. Now, one of the top performing names today, by the way, is a group which you may or may not be familiar with called Reinsurance. So we're going to go take a big leap here, tough transition from growth mega cap leadership to a name in the financial sector you probably don't spend a lot of time looking at, the Reinsurance group. But when I'm looking at biggest improvement here, Reinsurance is one of the top areas of the market. This is the Dow Reinsurance Index, and just the consistent uptrend is what's so meaningful. A lot of stocks, of course, have sort of chopped around in September and October. A lot of them made a new swing low in October, and now November has been really strong, trading back up to those previous highs. Something like Reinsurance has been above its upward sloping 50-day moving average this whole time, making a new 52-week high again today. But that's just the latest move in this uptrend that we've seen. Now, some of the names in this group you actually might be familiar with, depending on how much you dig into the financial sector and some of these reinsurance names. But look at just the technical characteristics of a couple of these stocks to wrap up our discussion. This is Reinsurance Group of America, usually goes by RGA. Look at the February, the May peaks, that same level of resistance in October, a breakout above 150, and again, now making a new 52-week high again in November. Nice uptrend above upward sloping moving averages. This is Arch Capital Group, ACGL, again, consistently above an upward sloping 50-day moving average. WRB is WR Berkley, which is a property casualty insurance name in the same general group, different type of insurance, but you can see, again, some really good breakouts. So, it's funny when I'm thinking of what areas of the market are showing new strength, are showing follow through, some of these insurance names still holding up quite well, and I'm inclined to follow charts that are working until they don't work. A chart like that certainly seems to be still working. That's our market recap for today. I want to bring on today's guest, Marianne Bartels, in a moment. Before I do so, a couple quick announcements. First off, we love to hear from you. We're going to do a mailbag episode, I think, on Monday's show, and we'd love to answer one of your questions on the air. Our email is thefinalbar@stockcharts.com. On Twitter or X, you can just tag us in a comment at FinalBarSCTV. On our YouTube channel, as you're watching a live broadcast, drop a comment in the live chat. Put a comment below the video that you're watching. We'll put all of those questions in the mailbag. Again, we'll do a special mailbag episode here probably right after Thanksgiving holiday. We'd love to answer one of your questions on the air. Don't forget about our other YouTube channel, simply called Stock Charts. Some great documentary style content about market history. Also some great information about the Stock Charts platform. Some tips and tricks about how to use our platform a little more effectively. So don't forget to check out our other YouTube channel. Also, by the way, our Black Friday week sale is happening right now. If you go to stockcharts.com/special, you will find that if you are a new member of Stock Charts, which of course you all should be if you're not already, but if you join right now in this week, you get 4 months free if you do any sort of annual plan. You get other free months if you do a monthly plan as well. No matter when you want to join Stock Charts, it's not going to be cheaper than it is right now. So I would encourage you, if you've not explored our platform, it is the most underpriced, undervalued thing in the markets. I would humbly and most biasedly suggest, but I would encourage you to check it out. If you are a current subscriber, by the way, you can extend your current subscription at the low rate if you do it this week. So go to stockcharts.com/special. Do it today before you do get into other things. I want to welcome on today's guest, Marianne Bartels. Marianne is the Chief Investment Strategist at Sanctuary Wealth in New York, New York. Marianne, I feel like I have to say howdy. Welcome to the show. How are you?
Howdy. I'm great. How are you? Thank you so much for having me back.
Hold on just one second, Marianne. Go ahead, Marianne. Sorry.
Dave, well, howdy. Thank you so much for having me back to the program.
It's good to see you. I love your outfit. I'm assuming that's going to line up with what we're going to talk about. It's well done.
Well, yep, and you teed me up, so I'm going to go. We are out with our year ahead outlook, and we're calling it the bucking bull. And we believe that we're going to be in a bull market for bonds next year, and the bull market in equities will continue, but investors might be bucking it a little bit.
All right, well said. I'm excited to get into your charts. We have a couple charts queued up. This first one is the XLG versus the SPY. So that's the S&P 500 top 50 ETF versus the S&P 500. What does this tell you about leadership here in November 23?
So obviously we were talking earlier in the year about FANG. Now we're talking about the Magnificent Seven. We know about this tech move, but I wanted to find another way to express this. And one of the ways that we used to do this many years ago at Merrill Lynch was to just separate the largest 50 stocks, and there's the S&P top 50, and look at it relative to the rest of the S&P. And here you see, Dave, this is a longer term chart. I have a saucer bottom. I think this is a major base that has been formed. We've traded sideways. We've broken out above that. We're hitting some resistance. I'm expecting this to continue and to break up and test the highs. And what will be really important, Dave, if we ever make new highs in this ratio, because my theory is that this is really a proxy for growth, that we're in a mega cycle for growth stocks that I think is underappreciated. I know these stocks have moved a lot, but I think they can move much more. And let me just add one more caveat, because I kind of do the blend of fundamental and technical. When earnings are scarce, you go into a growth cycle because investors are willing to pay up for the earnings in the companies. And the companies that are producing earnings right now are the Magnificent Seven, not the 493. And I'm not expecting next year to have an abundant cycle of earnings. And that would be value. You go to value when there's an abundance of earnings. So I think there's both a technical and a fundamental play here that's going to drive these top mega stocks higher.
It's so interesting when you show this chart. I mean, there's no denying there's been renewed strength in the mega cap leadership. We're seeing that here, coming off of the October lows. A lot of skepticism, I think, has been described, just looking at a lack of participation in small caps. How can the market go higher when it's just the largest names, leading the way? How would you refute that argument if the market's going to rally with mega cap growth just continuing to dominate to the upside?
Yeah, it's an important question. First of all, I think we've already started a January effect for small cap. I think we're going to get what's called a counter trend rally. I do believe small caps are in a bear market. They've been in a bear market for 12 years. You can be in a bear market for up to 15 to 20 years. So you can stay in a bear market. And my problem with small cap has to do with the regional banks. I'm very negative on the regional banks, but here again, they're so oversold. I think we can get a counter trend rally. So I think small caps can rally off their low 20%, and I think the regional banks can rally 30%. That's going to help some of the breath. But then I think the large caps take over and really hold leadership again.
So speaking of large cap leadership, we're going to look at semiconductors next. We have Nvidia reporting earnings today, of course, but semiconductors have been just an incredible long-term story. We've seen a renewed sense of that story here in 2023. Is there further upside to be had in the semiconductor space? Why or why not?
Absolutely. You've just had a major breakout on the SMH, and the relative has confirmed on it. And this is important, Dave, because the semiconductors have been the leaders in this cycle. If you start losing the leaders, then that has to question the leadership in mega cap. And this also ties into the artificial intelligence theme that we're moving to AI. And I think people are underappreciating the productivity enhancements that this is going to bring to corporate America. It's also going to lower unit labor costs. Again, you've got the technical and the fundamental aligned, and I still think these power higher.
Very, very interesting. Now, part of the story, I mean, arguably one of the most important charts in 2023 has been interest rates, right? 10-year yield has tracked pretty well. The bull phases during the year have been when rates have come off a little bit. What are you seeing from the 10-year yield? How does that inform your thinking going into next year?
So Dave, there's two stories on the 10-year. You can see that we were in a downtrend for the 10-year rates for 40 years. And we've broken that downtrend. So what does that tell us? That tells us we reached generational lows in 2020 and 2021. We're not going to revisit those lows. In fact, we're now in a secular uptrend for rates, but it's not straight up. I think now we go into a counter trend rally for bonds where they're going to come, rates are now going to come down. That's going to help fuel the markets in 2024. The other thing I want to point out, but I don't have it here, is fast money is actually massively short. So if we start breaking key technical levels in the 10-year, meaning rates coming down, you're going to see a massive short squeeze with rates coming down that much more. And you just saw the opposite in equities. Part of the rally that you just showed was a massive short squeeze because fast money was short. So I think there's a lot of power that can drive both bonds and equities going into 2024.
So one of the things we've been thinking about, of course, in 2023 has been the Fed, the pace of rate hikes. It now seems pretty much a foregone conclusion that rate hikes are now behind us. But now the idea of rates coming down is being pulled a little bit closer in next year. Still discussion, I think, about a recession and maybe a soft landing is not possible. Do you see a recession is likely in next year? How does that fit into what you're seeing from the charts here?
So we're not seeing a recession, at least not in the data that we're looking at. When we look at real GDP on a year-to-year basis, it looks like we had the recession in 2020 and that we're still in a recovery phase for GDP. In addition to that, there have been pockets where there has been a recession. If you look at leading indicators, they look recessionary. If you look at the ISM manufacturing, they look like they were in a recession. And it looks like they can now go into a recovery phase. So I think what could be a surprise in 2024 is what happens when we actually continue to have a recovery in the pockets of the economy that actually were recessionary already.
It's a great answer, Marianne. I'm going to ask you this question because, as you say, you wear many hats. On top of cowboy hats, you wear other hats as well. Fundamental, technical, macroeconomic, and just thinking about these different metrics. Anytime the market has had the run that it has and it keeps going higher, the discussion of valuations has to come up, right? And is the market overvalued, and how much can you justify getting further and further overvalued? What do you think about valuations going into next year? Are they sustainable?
They are sustainable. And one time I'd love to come back and show you a chart of PEs. If you look at secular trends in the equity market and chart PEs below it, PEs expand during a secular bull market. And I've never found, when wearing my quantitative hat, where PEs are a timing tool. Technical analysis is a phenomenal timing tool. PEs are not a timing tool. If my thesis is correct and we're going to go into a super cycle for growth, I'm saying PE multiples are going to expand and they can get to 25, 30 times. And relative to history, believe it or not, that's not excessive. That's not even close to what we saw during the internet bubble in 2000. So I'm actually expecting PE expansion to continue.
How, when you, given all the discussion that you've had, Marianne, which I really appreciate, thinking about this, potential continued run with growth stocks, how do you think about positioning between now and year end and then into the first quarter? Do you stick with some of those leading growth names? Are there other areas of the market that you find opportunities in, given these conditions?
Well, obviously, I still love the leaders, but what's interesting, you showed the VIX earlier. The VIX has come down quite a bit. Short term, we're overbought. I wouldn't be surprised as we enter December. If markets are a little choppy, we get a little bit of a sell-off, but then I think we're going to get a lot of window dressing, right? This has been a phenomenal year, particularly in mega cap technology names. And I think portfolio managers will continue to own them and possibly even maybe buy a little more because they haven't been in the portfolio, and that's what we call window dressing. So I think the rally towards the back half of the year will continue. I think there's a chance that we rally into January, then maybe we have another fumble. April is always a great month for markets seasonality wise. So again, I think there's going to be a lot of bucking as we try to figure out where the Fed is. Are they on hold? Will they raise because they're talking hawkishly? Will they have the ability to lower rates? Where are we on inflation? There's still, as you've pointed out, a lot of uncertainties, whether we have economic growth. Do we have a recession? Do we have a soft landing? I think it's very challenging times. But when I look at the charts tell me bullish because leaders are still leading. Cyclicals are leading over defensives. That tells me that markets should be able to power higher. And what I told you the last time on the program, and I'm just going to remind your viewers again, charts don't lie.
Well said. I love that, Marianne. Listen, it's awesome to have you back. I appreciate it. I hope we can bring you back in the new year. Until then, happy trails. Have a fantastic Thanksgiving holiday. We'll talk to you again soon, all right?
Take care, everybody.
It's Marianne Bartels. Marianne is the Chief Investment Strategist. I'm just laughing about the outfit. That's so awesome. She's the Chief Investment Strategist at Sanctuary Wealth in New York, clearly not taking life as seriously, and I really appreciate that too. It's the general way I like to approach things. If you listen to some of the comments Marianne had, I love that comparison, and what she does very well is wear multiple hats. Think about the technical, but not in a vacuum. And I find you can get into trouble when you just use stock charts and just think of them as charts and signals, and that's it. I think there's a lot to be added by thinking about the relationship of what you see from the technical perspective, what you see from the fundamentals of what these companies actually are doing, those expectations and how those change. That's what we're talking about, valuations looking forward and earnings growth. The macroeconomic picture, geopolitical issues, and all that together. And Marianne, I think, better than anyone, sort of combines those different disciplines in a meaningful way. But as she said, I think very eloquently, the charts don't lie. Folks, we've got to wrap this show and go to the 3 and 3, 3 charts in 3 minutes to tell the story of this market environment. Here's chart number 1. You know, we're thinking about the S&P 500. I can't disagree with Marianne's comments. I think that's really, really beautifully put about the leadership. And again, just trusting the fact that the charts are telling you the story that the market is working. Get bearish when that doesn't work anymore. I mean, that doesn't happen anymore. However, the S&P is testing significant resistance. And anytime you're looking at the current bar, what we call the final bar, and looking to the left, and we're testing an important level, I'm always waiting to see if we're able to break that. I would also say, look at other areas of the market that are sort of in a different configuration. Something like gold stocks. This is the GDX we have at the bottom, in what you might describe as an inverted head and shoulders pattern, which is only valid if and when we break above that resistance level. So I'd look for names like this to break higher. Stocks like Newmont Mining right now showing a bullish momentum divergence, suggesting that their recent downtrend may be near an exhaustion point. Might be the beginning of a rotation higher. It'd be very interesting to see if you get a follow through on gold stocks, which have been lagging behind growth names for quite some time. Chart number 2, we're looking at Nvidia, and of course, Nvidia reporting after the close today. We'll see what the market does with Nvidia tomorrow and beyond. But we're looking at a longer-term chart. It's the last 7 years on a weekly basis for Nvidia. And what I wanted to point out is just the long-term story that you see from the semiconductor space and Nvidia. Now, there's a lot of room if they miss earnings, if the stock drops. There's a lot of room below current levels and still be within a very constructive technical pattern on the weekly chart. For example, you could drop down to around 400, we'll call it. That would hold the lows from earlier in 2023, really over the summer into the fall. That's plenty of room below current levels, but still would be within a pretty constructive pattern, right? This is sort of the state of a lot of these leading names. They have room to pull back, but still be within a pretty constructive pattern. The weekly MACD, by the way, very close to a buy signal, which we haven't had for quite some time. Chart number 3, Live Nation. LYV is a name that actually traded down today. It's down over 3%, giving back some of those recent gains. Still having a pretty good run since late October, but this was a pretty significant drop, the biggest down day we've had in quite some time. But I wanted to highlight on the candle chart are these candles here. Look at the last 6 trading days, every one of them with a long upper shadow. And what that means is during the day, we've traded higher but closed lower. So you've actually had some bearish short-term sentiment on names like this. I find it where candle charts are really helpful are just telling the story of the short-term sentiment, how that's shifting. You see a lot of what are called doji candles, a lot of candles representing indecision, using this traditional Japanese form of technical analysis. So while today's drop may seem very sudden, I would say we've seen some signs here in the last week or so suggesting that the uptrend that we saw in Live Nation probably nearing an end point. Folks, that's a wrap for the show. Thank you so much for joining us every weekday after the close for the final bar. A special thank you to Marianne Bartels of Sanctuary Wealth joining us from New York. Don't forget to like this video and subscribe to our YouTube channel before you leave. We would so appreciate that. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be well, stay safe, have a good night.